income on it yet. Doesn't matter. Financial statements try to reflect reality, so you still need to account for your car's drop in value. You're not as well off as you would have been if your car's value hadn't declined. Notice that I used the word depreciated a few seconds ago. I did that on purpose because the first line of the cash flow statement after net income is often called depreciation. Depreciation expenses reduce income just like the depreciation on your car did, but they don't affect cash. On the cash flow statement, accountants add depreciation back into income to compensate. The same idea applies to corporate stock options when they're granted but not exercised. This usually appears in a line named something like share-based compensation. Stock options are a real cost to the company, so they have to be deducted from income, but they don't affect cash. You can find dozens of other lines on the cash flow statement, but let's skip them and get to net cash from operations. To get this, we just total net income and all of the adjustments. That gives us the net cash for the first of the three parts of the cash flow statement. The second part of the cash flow statement handles investing activities. These are investments at the firm level, such as building a new factory, as distinct from financing activities, such as issuing stock. You might see a line labeled additions to property, plant, and equipment, or maybe capital expenditures. Any item the company purchases for business that have a useful life over 1 year are considered capital expenditures. There may also be lines adjusting for acquisitions and divestitures, sometimes called just asset sales. Usually the last adjustment has a name like other investing activities to handle the things that aren't big enough to merit their own line. Add it all up and you'll get net cash from investing activities, which is the second of the three cash flow components. We won't take the time to go through the third component, financing activities. We'll just note that you'll find things like debt repayment, dividends paid, and proceeds from stock sales here. The result will be net cash from financing activities. After we add the three components of the cash flow statement, we get the net change in cash holdings. It's the total cash change in the company's balance sheet during the period. Although the world tends to focus on accounting profits, cash flow is what matters. You can calculate cash flow starting with net income and adding back depreciation and other non-cash expenses. Accountants will be the first to tell you that what they report as earnings doesn't really reflect the amount of money that the company produced for its shareholders. That's because, despite the accountant's best efforts, accounting earnings don't always reflect reality. My favorite example is the early years of FedEx. Federal Express initially had little or no profit because of huge depreciation charges from the cargo planes it had just put into service, so it had no taxable profits. It did have huge cash flow. The result was good stock price performance. So far, we've been discussing the levels on a company's financial statements, the absolute size of the numbers. That ignores the size of the company. What would be a lot of debt for a small bank like Citizens National with a couple of billions of dollars in assets would be just a smidgen for a behemoth like Bank of America with a couple of trillions of dollars in assets. Analysts calculate ratios to help handle size issues like that. For example, analysts get a feel for how much debt a company carries with the debt ratio. That's total debt divided by total assets. This can vary enormously from industry to industry. Bank of America's is in the area of 90% based on its balance sheet at the end of years 2010 through 2012. In contrast, Intel's debt ratio is much lower, ranging from 20% to 40% during the same period. Analysts can't agree on whether a firm should have a lot of debt or just a little because there are so many other factors involved. According to Forbes, Tiger Woods made over $100 million in the calendar year ending June 2010. With income like that, he can carry just a wee bit more debt than we can. Analysts do tend to agree that a rapid increase in debt is a bad thing, especially if comparable firms aren't showing a